6 years.
Exactly.
You know what? You got me. You got me. Sue is in Chicago. Hi, Sue. How are you?
I'm doing great. Thank you for taking my call.
Sure. What's up?
My husband is 62 and I'm 58. We've been married 38 years. We have no debt, and our net worth is a little over $1 million. 200,000 of that is in real estate, 800,000 in stocks and bonds. In 1997, we were raising 4 little boys, and my husband went through leukemia and a bone marrow transplant.
Ooh.
And so the only life insurance we could get was a whole life, and it was a $600,000 policy. Dave and Rachel, we put in, since 1997, $10,000 a year into this policy. Now, fast forward, 15 years ago, my husband had a heart attack and 5 bypasses. Longevity in his family, the men, just historically do not live long lives. So here is our caveat right now. All the boys are through college, married. We have 10 grandchildren. And this life insurance policy, the cash value is now around $240,000. My husband and I are trying to make this decision. He is still working. He has an income of about $80,000 a year. He hopes to retire at about 65. My income a year after COVID, I'm a Christian motivational speaker, so my income dropped from about $50,000 a year to now $20,000. We are trying to make the decision of whether we cash in this whole life policy and put into our stocks and bonds portfolio, given the fact of his life expectancy to be.
What's the face value?
$240,000.
No, that's the cash value. What's the death benefit?
It's $666,000 right now.
Okay.
That's scary.
So basically, if he
didn't she say she was a Christian motivational speaker? That's kind of rough, isn't it? Lady, I think you should cash in based on that alone. Just the fact that it's $666,000, I think that's a bad omen.
If he dies, when he dies, we all die.
Yes.
When he dies,
I understand.
if the policy is in place, you will receive $666.
Yes, sir.
Okay, that means they're going to keep $240. So you really have a $400,000 insurance policy.
Correct.
That's really what you have. Okay.
Am I missing something here? How did you just do that math? I don't want to disagree with Dave here. I really don't. I don't want to disagree with Dave, but you're still going to get $660,000.
What's he saying?
He's saying it's 666 minus the cash value, which I guess he's right in the end, because the cash value is money that's been built in the policy. I almost think, what's so funny, when I first learned about insurance, I kind of thought it in like reverse of how like a mortgage works, right? So with the mortgages, you're paying money to get equity. In life insurance, it's the opposite. You're paying money in and you're getting less and less equity because more and more of that money is money that you put into the policy. So as the years go on and you get closer to 100 years old, the majority of the money, if not all or more of the money they're giving back to you essentially is your money as you get older. And I think that's what he's saying. But it's still $666,000. I mean, that's how much you're going to get.
Okay. And so the swing is, do you need the extra $400 to live? And the answer is no.
Mm-hmm.
You don't. So if you cash it out and put $250 in there, or if you keep it, either one, you're going to be okay either way, financially speaking, mathematically speaking.
Mm-hmm.
Agreed?
Agreed.
Okay.
I don't want to disagree with him again, but we don't know anything about her expenses yet, really. I don't think they mentioned anything about expenses, so it might be a premature call. I usually agree with Dave Ramsey on the whole life stuff, so I'm going to keep watching and see. Maybe this changes.
So this really comes down to a bet that you're making, not based on the past, but for $400,000, I'm going to bet that I'm going to put in less than $400,000 before he dies. Right? Mathematically,
Okay.
it's very cold-hearted, but it's a math.
I think the better question would have been is, did you have an in-force illustration run on the policy? Because one thing about a whole life policy that is, I guess, one of the benefits of it is the fact that it receives a dividend. It's almost like owning a stock. So the more cash value they have, the bigger the policy, the more the dividend is. And that grows every year as the policy gets older. Now, the reason why I bring that up is that in a lot of these policies, you can actually use the dividend however you like. So you can use that to pay your premium. You can use it to get more insurance. So a good question to ask here, and again, on the spot, I don't fault Dave. I think his hatred of life insurance is as similar to most advisors that from the numbers. I know a lot of people that don't like it. But again, I think the right question here would have been to ask is, hey, like, did you run an in-force illustration? And does it look like those premiums can be paid at some point by the policy itself and the dividends? And based on the age, this video is from 3 years ago, so 2023. She got it in 1997, 26-year-old policy. This policy probably is ready to pay for itself, which means she wouldn't have to put down any money at this point. And then we can eliminate the $400,000 bet that Dave's referring to.
Thing.
Okay.
And so it's, and what's the
Like, can she save another 400?
Still at no, I'm saying she's paying for a $400,000 life insurance policy. In essence, they are paying. Okay, and if he dies before you put 400 into it, if you put 300 into it, you gained by 100. Right.
So in what I'm saying, you would gain by the 400 because you'd be using the house's money to pay the remainder of the policy, which is the ideal situation. But I just want to make sure we understand that dividend is decided by a board of directors, just like a stock dividend, and they can turn that dividend down, turn it up. So you can end up having to come out again to pay for that policy in the future, and then use any future dividends to continue to offset that, maybe not having to pay another dollar into that policy in the future, which is kind of cool. Again, you're in the position, you might as well make lemonade out of lemons.
And that's the math. Good, but and is it currently, and it will be forever, $10,000?
Yes, and that's been our first. Since we got it, we fund that first, and then our employee matching, and then our Roths. That's been our.
Yeah. Well, that would not be my order of priority.
I love Dave for saying that.
But if we're just making bets at $10,000 into $400,000, that's 40 years, is it not?
Yes, it is.
So if you're just placing bets on the math, you're going to keep it.
Okay.
It's a crappy product. I probably would have dropped it 15 years ago.
I knew that was coming. And honestly, I own whole life insurance. I don't hate the product, but again, it really depends. I think it's sold as a Swiss Army knife pretty often to people, and it's sold as a way of saving money. I think to not fund a Roth IRA to fund life insurance, I think that's a crazy thing. The fact that the Roth IRA is the last thing you're looking at and you qualify for it, that's crazy to me. So I totally agree with him there. I think he's got a really good point.
Or 10 years ago, and save that money and quit then. And I hate it. I think it's a horrible product. But at this stage, what it's come down to is if you're going to get 666 upon his death, which is a weird number, by the way, but
yeah, it is. It is.
But if you're going to get that upon his death, then and they're going to keep 240 of yours, that's 426 difference. Then he's got to live 42 years before you don't come out ahead. If I'm doing my math right, am I doing something wrong? I mean, 400 divided by 10 is 40, isn't it?
Yes.
Yeah.
Yes.
And so 420 divided by 10 is 42 years. He's 62, so he's got to make it to 104. Probably not happening. I mean, I'm probably not making it to 104, and I got longevity in my family, so, you know.
Right.
But,
and she
gotta love how absolutely honest and like, that's, I don't know if I could say that to somebody on a phone call. Good for him.
She comes out better ahead doing that versus cashing it all out, taking that $250 and putting it in an investment.
Yeah, I mean, that's a very simplistic way of doing it, okay? If we want to get one more level of sophistication, we could say the present value of that money.
Right.
In other words, were you to invest $10,000 a year, how long before, and at an 11% rate of return in your stocks and bonds, what the market has returned, how long before you'd get to $400,000? I don't have that off the top of my head, but...
Well, I'm going to do it right now. Okay, so you get a $10,000 a year over 10 years, 10%. You get $175,000 in 10 years from now. In 20 years, you get $630,000. So, yeah, I think the math works out better here. Now, there's one thing I'm going to point out, though. This is important because with a policy that's that old, right? If a policy is as old as this one is, chances are they may have made a few dollars in this policy. And I think based on the numbers, they're pretty close to that. Let's just say for the sake of discussion, again, let's say they've made some money in this policy. If they cancel this policy and cash it in, they're actually going to have to pay taxes on all of the money that they made over and above whatever money they put into it. So there's a way actually to not pay those taxes and continue the deferral. And that's called a 1035 exchange. So you can actually 1035 the money that's in a policy. You can 1035 it over to an annuity product. And they actually have annuity products now that are very close to how brokerage accounts work, where you have a whole bunch of funds you can choose from. There's some very low cost ones out there. And they'll act just like a regular investment account. You'll have your ETF and mutual fund types of funds in there. Some of these, they have dozens and dozens and dozens of choices, some of these low-cost ones. And you can continue investing like you would in your traditional brokerage account, just inside of that annuity wrapper and continue the tax deferral. So it's something to consider in a case like this where you don't want to pay the taxes and you don't want to have that shrinkage there.
I have that off the top of my head, but it's probably still 20 years.
Right. So if I'm tracking with you right, because this has been a dilemma for me, we're pretty financially savvy. We did Larry Burkett before we heard of Dave Ramsey and have done the envelopes before they were cool. And I think about if I pull out the cash benefit of $240,000 approximately, and I invest that. Plus, I'm freed up $10,000 a year to
You're
also invest.
You're right. Your equation is more complete than mine. You're right.
Right.
You're exactly right.
It kind of swings this pendulum the other way.
Well, you got to get to if you do that, you got to get to 666, but you'd get there.
Oh, let's do this right now. So let's go 20 years. We're going to use Dave's 10% return, $240,000, and then $10,000 a year in premium payment that she'd be making. Let's see what the answer is. That actually put her at $2.244 million over 20 years. Yeah, I guess the whole life loses, doesn't it? That's pretty significant. So not only did she pass the $666,000, she 4x'd that into $2.25 million. So I think the answer here is the whole life just not the way to go for her at this point. I think it served its purpose. It provided the insurance during years where she needed it because she was raising 4 kids. I think that is that's the point of insurance. But as far as an investment's concerned, in this case, when we test the numbers based on what Dave's advice was, which again, he's right here, and based on the numbers we just ran with his financial calculator, yeah, I think he's given the right advice. Let's see how this ends.
With the 250
you'd get there in
invested.
6 years.
Exactly.
You know what? You got me. You got me. You didn't need me. I needed you. Okay.
Oh,
yeah, you're exactly right. You're exactly right. I left a variable out of that. Oh, wow, that was dumb. Okay, you got it. You're exactly right. Good. No, you're exactly right.
You know what, Dave? Not mad at you, buddy. You're giving advice over a phone, spur of the moment. Honestly, you got to the end, and in the end, gave her the right input. Listen, these types of insurance products, I have friends that do super high net worth clientele, and they use life insurance all the time with those clientele because those clientele, there's a tax arbitrage in how they use it. But in a case like this lady right here, millionaire next door, I think we're proving at this point that that product and the way that she was trying to use it, just not working. And ultimately her formula that she came up with and her reasoning for wanting to get rid of that policy, I think she's right. I think Dave's right. I'm actually really glad I got to agree with this video. So thumbs up, Dave. Good job.